I'm Emily Cheng in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, tech shares leading a rout in U.S. stocks as investors rotate away from pandemic-era winners. Meantime, Gamestop surging more than 100% on retail investor action. Volatility and volume, the words of the day. We will have the latest. Plus, ARK Investments' Cathie Wood says Bitcoin has trillions in market cap potential. We'll talk to the new co-president of Galaxy Investments, Damian Vanderwilt, about what he thinks. An exclusive interview. And executive perspective, Twitter's Ned Siegel on Analyst Day and Redfin CEO Glenn Kelman on earnings. I'll speak with both. But first, let's start with the U.S. markets. The Nasdaq dragged down by a sell-off in tech. Meantime, a flurry of tech stocks out after the bell, including Salesforce, Airbnb, and DoorDash. Bloomberg's Kriti Gupta joins us now with more. So talk to us about this sell-off.
Well, hi, Emily. A risk-off day in the markets today. You really saw tech leading to the downside. Let's just start macro here. The S&P 500 posting its worst day since since October. The Nasdaq 100 since October as well. But the SOX index, the worst since September. Now, what happened in September and October? It was those tech corrections and the lead up to the election. You really saw a lot of tech pain there. So there are some historical parallels to be made here. A lot of this also showing up from the yields picture. Yields boosting, surging, I should say, really spooking equity investors. Flip up the boards and we'll look at the Nasdaq 100 specifically. Look at those futures over a 3-day period, really sticking to that range pretty closely. Something interesting levels to be watching there. I want to flip up the board again and look at another major equity story, and that is GameStop surging for a second straight session. Look at that in 2 days. 141%. That's how much the shares have risen. Really important to note that retail trading still having a massive impact in the stock, even though you've seen short interest fall back even further. And lastly, Emily, you mentioned those earnings. I want to show you what's happening in the post-market with some of those names. Let's just kick it off with Best Buy down 9%. As holiday sales and the 2021 outlook disappoint investors. That shift to travel and dining that people are expecting in 2021 could hurt their business. Salesforce, their profit guidance, same idea, coming in light. This idea that big tech momentum you saw in 2020, that won't last in 2021. Dash as well, DoorDash, revenue tripling, but their losses doubling from a year ago. Shares down as much as 13% in the post-market, now down only 5.4%. And lastly, Airbnb beating estimates, showing that some of demand despite that COVID surge, but still down on the day in line with the rest of the market. Emily, it is not a good day for tech, and that's clear even after the market closes.
Not a good day. We're going to talk to Airbnb CEO Brian Chesky momentarily about that beat on estimates and their outlook ahead. Brian Chesky coming up. Also, I'll be speaking with Tony Xu, the CEO of DoorDash, tomorrow. Kriti, thanks so much for that update, for all those conversations. Keep it right here to Bloomberg Television. Now, even on a down day, stocks popular with the day trader crowd surging once again. GameStop, as Kriti mentioned, doubling at one point before ending 19% higher. For more, I want to bring in our cross-asset reporter, Katie Greifeld. Katie, walk us through the highs and lows today.
Well, it was an interesting day because it actually felt like the GameStop story was a sideshow, whereas for weeks, this was all anyone was talking about. But GameStop, it was halted 4 times, even in the early hours of trading, was up as much as 100%. It paired those gains. It closed just 19% higher. And what's interesting here is you saw stocks like AMC, Express, BlackBerry, some of those other Reddit favorites, they actually paired their gains, erased their gains in some cases. And it's just interesting to compare this moment to what it felt like at the end of January, because again, we're seeing this enthusiasm in GameStop, but if you look at the options market, for example, we're not seeing the activity that we did back in January. So there is a question to how long this will last. I mean, no one expected it to come back, so it's already surprised us there, but there are questions that maybe this time it won't be as long lasted as it was in January.
I want to talk a little bit about GameStop specifically. Obviously, we heard the news about Jim Bell, the CFO, resigning earlier this week. You wonder if this is part of Ryan Cohen's big plan for some sort of turnaround. What is fueling this new momentum?
So that is an open question. And to the point that, AMC, Express all, fizzled out those rallies, GameStop might actually have some fundamental news behind it. So we found out this week that Chief Financial Officer Jim Bell was pushed out. Bloomberg News reported that was over a disagreement in strategy with Ryan Cohen, the Chewy.com co-founder, who's now a member of the board. And some people are pointing to the fact that we really saw GameStop take off yesterday after Ryan Cohen tweeted a picture of McDonald's ice cream, which sounds like nothing, but a few people have pointed out that it could be an allusion to, perhaps Cohen is going to turn around GameStop the way that McDonald's finally fixed its ice cream machine. So the Reddit crowd at least took that as a very bullish signal. So that's just one theory behind why we saw such a big pop yesterday and even today, 19% higher. Not as high as we closed yesterday, over 100% higher, but still a huge gain.
So let's talk about some of the other edges of the market here. Bonds flattening. You've been pulling out some other interesting trends.
Yeah, it was a brutal day for tech. And I mean, if you look at the NASDAQ 100, only 2 stocks closed in the green. So it was a brutal day for tech. A lot of people have pointed to the bond market as a reason why, because even the parts of the market that would typically benefit from higher yields took heat today. All the sectors pretty much closed negative. And that's because people have been focusing on the rate of change in bond yields. You saw rates rise by levels that we haven't seen in over a year. So that might be spooking equity market investors a little bit. People are wondering how the Fed might respond. So that's why you saw just this general de-risking across asset classes.
So what are you expecting tomorrow? Obviously, we've had this tech sell-off ongoing. You see GameStop defying the odds. What is next?
I want to see how this plays out in different funds and different portfolios, because I was watching risk parity, for example, today, and that's a portfolio strategy where you have equity and fixed income allocations, and you try to match the volatility of both. So on a day where you have both bonds and stocks selling off, that's very painful. And a proxy I like to look at is this risk parity ETF. It had its worst day since March 18th, 2020 today, because, again, you saw stocks and bonds sell off together. So it's going to be interesting how this impacts different funds, different portfolio managers, and how they sort of switch their positions around to try to contend with this market.
All right, Bloomberg's Katie Greifeld will be looking for your reporting tomorrow. Thanks so much for rounding it up. All right, coming up, Twitter shares rising amidst the tech sell-off as the company makes big announcements on Analyst Day. We're going to talk about all of that and more with Twitter CFO Ned Siegel. This is Bloomberg. Twitter reveals part of a potential subscription product that'll let users charge their followers for access to special content or experiences, a new feature called Super Follows. This, as the social network targets to double its annual revenue to $7.5 billion by 2023. Joining us now for more, Twitter CFO Ned Siegel. So talk to us about how this plan will work.
Well, we announced a few things we're really excited about this morning. We want to double our development velocity. That will allow us to ship new features and realize our other goals, which are 315 million or more MDAU by the end of 2023. And as you mentioned, doubling or more our revenue to $7.5 billion in 2023. We're moving faster. We're innovating in great ways. And we have the confidence to put long-term goals out there and to invest to realize them.
Super Follows, I should say. How much money do you think this could generate, and what's the reaction been so far?
Well, we're really excited to talk about Super Follows. One of the reasons is this is an example of a subscription that may benefit the content creator in terms of putting money in their pockets as opposed to putting money in ours. We want to facilitate transactions that help people put their best content on Twitter with their follower graph, with people finding all that incredible content to add to what's already on Twitter today. We'll also work on other subscriptions as well, which would be areas where we might provide a premium service to a consumer or to a business that they'd pay more for today than the way they already use the service. So there are lots of opportunities for us around subscriptions to help people.
So look, you want to add 120 million users over the next 3 years. What makes you think you can do that if you've gotten to 190 million in 15?
Well, we added 40 million MDAU over the course of last year, and we had more people who came to Twitter and became a daily active user because of product improvements than we've ever had before. The top of funnel, the number of people who come to Twitter every day that haven't been on it for a month or more, who have never used the service before, has been really consistent at about 2 million. So we have lots of opportunities, and we're doing a better and better job of helping people find what they're looking for once they come. Kayvon today, our head of consumer product, he shared that we grew our MDAU 84% year over year in India, just as an example of where we're seeing explosive growth and lots of opportunity to get to 315 million or more in 2023, and hopefully far beyond that over time.
Your Clubhouse competitor Spaces is live. I've been checking it out. What is the opportunity that you see there?
Well, this to us is just a natural extension of serving the public conversation. Text, images, video, audio tweets, and audio chat rooms. When you can find the topics that might be most interesting to you, join a conversation or listen to one, when you can tweet alongside them, or when you as a content creator, Emily, can create a room and talk about one of the topics of the day around Silicon Valley on our service, we feel like we're really extending the way that we can serve the public conversation. It's in beta today, but we hope to roll it out more broadly soon. We're really excited about it.
So are you concerned, though, that you might miss the wave that Clubhouse is now riding and it'll be too late? They will have defined or taken that category.
I think we're talking about a way that people communicate and not a particular service. People want to be a part of a conversation. Sometimes they don't know all the people who know about or are interested in the topic that they care about. One of the things that Twitter's really great at is helping people find those people, find the topics, find the details around the topics that they care about most. And so this feels like a real natural extension to the way we already serve the public conversation. I don't think this is a moment in time. I think this is a great way that we can leverage what we already have on Twitter to do an even better job of it.
So, look, Jack Dorsey has been called to testify again on Capitol Hill in March. There are a lot of issues percolating, still folks who believe you shouldn't have banned the president permanently. I know last time we talked, you said there's no path back for Trump to Twitter. Bill Gates just told us he thinks that's the wrong call. I know everybody has an opinion. But are you at all reevaluating that decision or future decisions of that nature?
I think we've covered that one, Emily. But one of the things that's great is whether it's Bill Gates having an opinion about our policies or others, they come to Twitter to be a part of that conversation. And whether the topic is our policies or our products or even our analyst day, people are able to find other people who want to talk about it and hear from them on Twitter. We hope that the conversation, recognizing that lots of people come at these things from different angles around our policies, is constructive, and that people listen to each other. And we're always eager to learn and observe what the world says about the way that we run the company. You probably noticed, Emily, that in the recent past, when we do update a policy, we often put it out for comment first so that we can hear from and learn from people who use the service before we complete the policy work.
Now, looking ahead, we've been following Snap hitting a $100 billion market cap, which is fascinating given they considered selling to Facebook for $3 billion. Obviously, TikTok is out there. How much do you think these other services are a threat, given that they cater to a younger user, and that could be the next generation of Twitter?
We just think about helping people find what's happening in the world and what people are talking about. There are terrific apps on our phones to use for other use cases. Sometimes they overlap a little bit with what we do. Oftentimes, there are people who you can find on other services. But when you want to know what's happening in the moment, whether it's around sports or entertainment the launch of a new product from a company that you're a big fan of. Twitter is a great place to see and be a part of that conversation. And that's something that's pretty unique to us. And as we become better and better at helping people find those conversations and feel safe being a part of them, you're seeing it show up in our results.
We saw a huge tech sell-off today, though Twitter defied gravity, ending the day up, almost 4%. We've talked a lot about the possibility that we're in a tech bubble, that bubble could be close to popping. What's your position on that?
Well, I'm much better at assessing what's going on at Twitter than I am thinking more broadly about stocks, or maybe I'd be in a different role. But when we look at Twitter, we've never felt more confident about our strategy, about our team, about our execution. And on the heels of those things and our thinking around them, we are doubling down and investing more in 21 than we did in 20. We're going to grow headcount more than 20%. We're going to grow expenses 25% or more. We said that we expect revenue to grow faster than that. We've got a posture of investment because of our confidence. And so we'll have to see how it plays out in the broader economy. But with these two really big market opportunities, that is billions of people who still don't use Twitter and over $150 billion of digital ads that isn't spent on Twitter every year, we feel like there's still lots of opportunity for us to continue to invest to drive growth.
And how should investors assess the potential regulatory headwinds, given increased scrutiny in Washington, not just on Twitter, but on big tech in general?
Well, we live in an incredibly dynamic time. And I suspect that the conversations around privacy, around how companies choose what does and doesn't happen on their service around Section 230 here in the United States, these conversations will go on for many years. And we feel like we have a really important role in these conversations in speaking for millions of websites who have reviews of products, who have chat rooms, who have public conversation on them, where today the companies aren't held to account by government for what somebody might say on their service, but we are held to account by our shareholders, by our employees, by the other people who use these services. And we want people to think about transparency and choice as a way to solve the concerns that the world has around these things. And we worry that regulation may end up benefiting the very largest companies, but not the millions of other companies who would face the same regulations.
All right, Twitter CFO Ned Siegel, fascinating to watch the developments out of Analyst Day, and we'll look to see where those products take you. Thank you so much for stopping by. All right, coming up, Salesforce shares slumping in late trading after reporting its earnings results. All eyes on the current state of its acquisition, Slack. We will break down the numbers next. This is Bloomberg. Salesforce earnings out after the bell. The company boosting its revenue view, suggesting customers have started spending more on its software after slowdowns fueled by the pandemic. I want to bring in Groove CEO Chris Rothstein to break down the latest results for us. Shares down after hours. Chris, what's behind that?
Yeah, they reported another solid quarter, $5.8 billion in revenue, 20% year-over-year growth, and so on. But you're seeing overall the market had kind of a rough day overall. And I think there are some investors that are wondering if they're going to grow mainly through acquisition, which you are seeing, even though they raised their guidance, the acquisitions are paying off for them. Tableau was a significant acquisition, and actually for the fiscal year 21, which they just finished, the platform was actually their number one overall area, and service number two, and actually sales, what they're known for, was number three. So these big acquisitions are paying off, but they just keep getting bigger and bigger, which I think is worrisome for some investors.
So do you think Slack will pay off for $27 billion?
Yeah, that's a great question. When they announced it, the stock also went down a little bit at that time. But I think whenever you have one of these huge acquisitions, even when you look in the past with Instagram and Facebook or YouTube and Google, and there's many, many of them, sometimes there's a reaction that's not great. But at the same time, this is a huge opportunity for Salesforce to move from departmental software where they just sell into sales or marketing or one area to getting every employee on their platform. And that's a big change they need to make if they really want to continue to compete with Microsoft and a lot of the other big enterprise players and continue to move forward in their vision.
So let's talk about the competition, because obviously there's Microsoft, there's smaller players like HubSpot. How well positioned is Salesforce to do vis-a-vis the competition?
Yeah, I think they're well positioned, but they have some great competitors. HubSpot is doing very well. I think their market cap's around $20 billion now, and they have specifically stated they're focusing on CRM and some of the core areas where Salesforce is known, and they really want to become the leader for growing, high growth companies, and that's an area that will be challenging Salesforce. And then Microsoft, ever since they've acquired LinkedIn, has continued to push forward there, and they're doing a lot more bundling of their services, which is also a danger and competitive threat to Salesforce. But they're well positioned because they also have this large ecosystem and people continue to build for them, which has protected them historically.
Okay. So the tech sell-off that we saw today, is this a blip or is this part of a longer trend?
Yeah, the market has been doing very well, and a lot of these stocks are valued at 30, 40 times revenue. So I do think there is some room where it can go down. But at the same time, the fundamental companies, most of them are putting up impressive numbers. They're hitting guidance in a lot of cases. They're still growing, and they still have a lot of runway ahead of them. So we'll see. It's kind of the classic quote: in the short term, the market's a voting machine. The long term, it's a weight machine. It might be a blip, or it might go on for a little longer here.
All right, Chris Rothstein, appreciate your insights there. We're going to continue to listen into Salesforce earnings call, bring you any updates as we have them. The CEO of Groove there. Coming up, we speak to Galaxy Digital co-president Damien Vanderwilt about the rise and fall of Bitcoin, Tesla and Square's decision to invest in the cryptocurrency, and will that really become a mainstream trend? That is next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Leading voices spoke virtually today at the Bloomberg Crypto Summit, and the big question was, what will it take to push digital assets over the edge and into the portfolios of the world's largest investors? Take a listen.
It's coming to the forefront of the conversation with all companies, private and public.
Over the course of 2021, we're going to see even more corporate participation in this asset class.
We believe there's a $100 trillion total addressable market for a digital monetary network.
When you aggregate all of these use cases for Bitcoin,
show consumers use cases for this technology, and then they'll understand what it is.
You do get into the trillions of dollars of market cap potential out there.
It makes sense to buy as much of that asset class as we can.
Because really the career risk has gone from why to why not.
For more now, I'm joined by Damien Vanderwilt of Galaxy Digital and Bloomberg Sonali Balsik. Damien, thank you so much for joining us. In his last interview with Sonali, your colleague Mike Novogratz said every company in America would be investing in Bitcoin like we've seen Tesla and Square do. But I just looked at a recent poll from Gartner that's showing just 5% of finance executives are even thinking about this. So how many companies are actually going to be doing this, and how soon?
Yeah, hi. Thanks for spending some time with me. I think there's a few different things to consider when answering the question in terms of pace. When we think about the conversations we have with corporates and institutional clients and any part of those constituencies considering investing in the sector, the first order problem is safety, and are the assets that they're buying going to be safe and available and secure? And the second order problem, particularly for the corporates, is tax treatment and the way that, particularly under GAAP accounting in the US, Bitcoin is viewed as an intangible asset. They're not unsolvable problems or things that companies can't get comfortable with, but it does take a little bit of time. And what's happening at the moment, the big four auditing firms, most of the major investment banks and specialist firms like Galaxy are really working to educate corporates, corporate treasurers, and folks at institutions on how to think about that, how investors will think about that. And we're watching pretty carefully the dialogue that some of the pioneers in corporate America are having with their investors. So, Michael Saylor at MicroStrategy, Jack Dorsey at Square, and others. And as we learn and experience more of how their shareholders are feeling about the allocation, I think there will be a growing comfort in the treasury functions at corporates to start to move forward and contemplate small allocations into the sector.
Damien, you came from Goldman Sachs over to Galaxy. When you're talking to the big investment banks, what do you think their first moves will be in terms of their retail and institutional client base in crypto?
Yeah, listen, I think most major banks, as Mike mentioned earlier today with you guys, at the moment are working on products for their retail, particularly their high net worth channels. And so we're in the middle of thinking through that with them, and again, helping the banks figure out how to have a safe product for their wealth channels. And that's where we can, particularly help architecting products, figure out the right way to custody it and understand risks. So I think the first point of entry for the big banks will be there. I also think banks are really thinking seriously about the fact that our sector currently has no access to wholesale funding. And, for people who know the sector well, they will understand that interest spreads on a lot of the product that we trade are very, very interesting. And so I suspect in the near future, you'll see some of the large banks starting to work with people in the sector like ourselves to provide wholesale finance facilities. I think when you look at the information that was revealed today in the market, which is really important for the sector, and that was the S1 filing of Coinbase, implicit in that is that they have done a lot of work with the SEC throughout the period of confidential filing and today to get the SEC comfortable. There will be a lot of back and forward dialogue that we look forward to seeing once they go into their effective period. But implicit in this being released today is that their lead advisory banks have done a lot of due diligence and become comfortable with working with this sector, in particular that company. And so this will start to open the doors in all the different committees and control functions that banks have to being able to do more things in the sector. And I think lending might be next after wealth.
Well, on that note, we heard Janet Yellen earlier this week saying that Bitcoin is an extremely inefficient way to pay. I also spoke to Bill Gates, who is not bullish on Bitcoin at all. We talked about the possibility that Tesla could make more money on its Bitcoin investment than from profit on electric cars in all of 2020. And take a listen to what Gates had to say.
Elon has tons of money and he's very sophisticated. So, I don't worry that his Bitcoin will sort of randomly go up or down. I do think people get bought into these manias who may not have as much money to spare. So I'm not bullish on Bitcoin. And, my general thought would be that, if you have less money than Elon, you should probably watch out.
Damien, what's your response to that?
Listen, I think it's difficult to take one extreme response to how to think about this sector from an individual. I think when people are looking at the allocation of assets that they need to make with their particular circumstance, whether it's an individual, whether it's an institution acting on behalf of many individuals or pension plans, or in a corporate, as we talked about before, your particular circumstance is different to lots of other people, and the available asset allocation options that you have will be very different. And so I think when you contemplate what we see today as being the likely path for what people historically thought was a very safe asset, the US dollar or gold, when you have the backdrop of looming inflation that is starting to permeate pretty intensely in markets with what we saw in 10-year bonds today, then I think you could make an equally compelling case that having a hard asset like Bitcoin that is very secure, very easy to transact with relative to any of those other comparable assets, then making a small allocation into this sector seems very reasonable to me, subject to your own asset allocation requirements.
Damien, at Galaxy, counterparty trading volumes grew over 80%. The counterparty loan book grew over 300% in the fourth quarter. Significant volumes you see there over at Galaxy. Can you keep it up, or was this just a standout quarter?
Yeah, listen, the one thing we can't buy here is time, unfortunately, and we're working 20 hours a day to service, the herd of clients across those constituents that are here and need our help. Currently, there are only a handful of institutional grade players in the market that people are comfortable trusting to do their business. You know, the safety element I've mentioned a handful of times is super important to all of the clients that I've grown up on Wall Street covering. And that safety requirement takes time. It takes time to walk people through diligence process, the custody process, how risky or not it is to move coins around. And we are hiring as fast as we can. I think Mike mentioned this morning to you guys, we're trying to hire 50 people in the first quarter to keep up with all of the client demand that we have at the moment.
All right, that's certainly some expansion. Damien Vanderwilt of Galaxy Digital, thank you so much, along with our own Shanali Bosick. Of course, we will continue to follow your efforts. Coming up, President Biden's new executive order aims to boost U.S. chip production and review supply chain security risks, with moves on the table to make the U.S. less reliant on foreign supplies. What will this spell for U.S.-China relations? We're going to speak with Huawei's chief security officer next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang. President Biden is working with Congress to secure $37 billion in funding to boost the domestic chip industry. This current crisis stemming from a series of things, including excessive stockpiling from Chinese telecom companies like Huawei that were blocked by the Trump administration from buying American-made technology. Joining me now to discuss the global chip shortage and U.S.-China relations more broadly under a China presidency, Andy Purdy, Chief Security Officer of Huawei. Andy, thanks so much for joining us back here on the show. So put this in perspective for us. How bad is this chip shortage, and how much worse will it get?
Well, first of all the companies that sold to us that helped accumulate the stockpile, the American companies, did so pursuant to licenses that were issued by the government. So the government knew what we were allowed to buy, and I'm sure had an idea of the volume. A combination of the coronavirus and the impact on, not to be too technical, the entity list, but the ability of American companies to sell to us and others, it's really had a very negative effect on us. And it's, of course, cascaded into an impacts in Europe, the auto industry, others. We lost out at probably 15, 20 billion in 2019 because of this. We had a significant impact this year, although we were in the black for 2020, as you may know, up in revenue and profit. But we're hurting, and we know we're going to be hurting going forward. So we hope that in the interest of the American jobs, from the $12 billion or more that Huawei spends to American companies for non-sensitive products, which should translate to about 40,000 jobs. We hope the Biden administration will focus on what's in the best interest of the United States on the question of whether those companies can sell to us. And I think eventually the decision will be made that it's in the long-term best interest of the United States if those sales are permitted.
So if sanctions continue, what position will you be in?
Well, as I said, we're hurting. We expect to continue to be hurting. Some of the things that we've had to do over the last year or two, we've had to prioritize some of our products, those products that may not need certain kinds of chips, those products that are most important to customers, to make sure that we, in effect, ration the use of the of the technology that we have stockpiled, and the same kind of process going forward. It also helps us prioritize what we're going to do, what we are doing in terms of research and development. We spent about $20 billion in R&D last year. That's up in part because of the need to adjust. And we're looking hard to find alternatives to these products. And it's difficult. We have not answered all the requirements that we have. And so we're going to be hurting for a while, but we're going to get through this. The leadership of our company are not going to lose their jobs because we have some tough times, but we're in this for the long haul. And I just hope that the American jobs are going to be here for the long haul as well.
So how are you getting on with the Biden administration thus far, and how confident are you that things could or will change?
Well, we're certainly not confident, and we are not reaching out to the Biden administration yet. As you know, the senior leadership in the relevant issues that are priorities to us, hopefully the settlement that will lead to the release of our chief financial officer, Meng Wanzhou, and the issue of the entity list. The leaders of justice and commerce and the appointees in those positions are not there yet. And we recognize that the priorities of the U.S. government are the pandemic, the economy. I'm very heartened to see that there's a focus on the American semiconductor industry, on supply chain risk. And frankly, there are important efforts being led by Ann Neuberger with the National Security Council coming out of the SolarWinds cyber attacks. America is going to be a whole lot safer. There's going to be a lot greater transparency. There's going to be great efforts for a safer supply chain. And those processes, informed by some of the stuff that Germany's doing, the European Union, hopefully are the kind of things that when the Biden administration is willing to talk with us, we can talk about proven risk mitigation measures that can provide assurance, and there can be transparency.
So look, while you wait and while you hope, can you keep your core businesses running, and for how long?
We will definitely keep the core businesses running. We expect it to be for the indefinite future. We will be having our annual briefing with the press, as we did last year, in probably sometime early in March, where the leadership will go into a lot more detail, and hopefully they will be able to give us some of the specific metrics or specific data that you're asking for in terms of what's going to be impacted. Are certain things going to have to stop? Are other things going to continue? And how big an impact on the core business. Certainly had a big impact on our mobile device business, but we did release a new device with our own operating system. So we're not giving up.
All right. Andy Purdy, Chief Security Officer of Huawei. Thanks for giving us to us straight. Appreciate you joining us. Still ahead, home prices are soaring across the U.S. as buyers fight over an increasingly scarce resource, and that is listings. We're going to talk to Redfin CEO Glenn Kelman about his outlook for the housing market for the year and the company's fourth quarter results. That's next. This is Bloomberg. Redfin shares fell more than 19% despite better than expected fourth quarter results, a revenue forecast also which topped consensus views. The online real estate platform has seen a massive boom in the mortgage business over the last quarter with 210% sales growth. This as mortgage rates in the United States rose to the highest level in 6 months, with higher borrowing costs threatening to crimp the pandemic housing rally. Joining us to discuss, Redfin CEO Glenn Kelman. So Glenn, obviously it was a crazy day for tech in the markets, big sell-off. Do you think you're getting caught up in that, or is this something different?
I have no idea. Oh, wow, I sound a little froggy. I have no idea. We had a great quarter. We beat our own expectations, analyst expectations. We guided up. So there's going to be volatility in the stock market. There's going to be volatility in the housing market, but we're going to keep taking share. So I can't worry too much about what happened to our stock in one day.
So let's talk about your outlook on the market, because there are some fascinating and, I don't know, maybe unprecedented trends happening right now. Obviously, you're seeing this record, people fleeing from cities, buying houses in other areas. You're seeing inventory really tightening up in some places. What are the trends that you would highlight?
Well, I think you did a good job. America is on the move. So right now, inventory is rock bottom. It's like a Soviet-era supermarket. The shelves are completely empty. I have never seen any market like this. We've had listings with more than 150 showing requests that are getting 30 or 40 offers. Buyers are bringing lawn chairs to line up to get into an open house. Builders report that their wait lists are 90 deep for a single unit. So it used to be that way in San Francisco or New York, maybe in Los Angeles or Seattle, but now it's everywhere. And it's just distorting the space-time continuum of these local economies. In Nashville, people looking within Nashville are spending about $400,000 to buy a home, but out-of-towners moving into Nashville are spending $700,000 or $800,000 on a home. So it's really just changing everything about that economy.
Does this change in, let's say, the second half of the year when folks are mostly vaccinated, or does this go on for several more years as part of a prolonged trend or shift in population distribution?
Well, I think there's a long-term migration trend that began before the pandemic. People were leaving major cities because there was an affordability crisis. And it may ease somewhat, but even when people are vaccinated, I think they'll be liberated to work where they want. Many employers are saying you can work from home, you can work remotely, and that has just created space for people to go where they want. Interest rates are probably going to increase, but 15% year-over-year price increases like we saw in December and January aren't sustainable anyway. So I hope that demand slackens somewhat to a more sustainable rate.
Speaking of what's happening in the public markets, obviously I'm sure you've been following the GameStop mania with great fascination. How are you digesting this as the CEO of a public company?
Well, I just don't think you can worry about how much your stock goes up or down in a single day. You just have to create long-term shareholder value by delivering better service to your customers, by taking care of your employees. There's a tendency in the press to look for a hero and a villain. And sometimes the smaller investor, the retail investor, has been seen as the hero and the hedge funds have been seen as the villain. But I'm not sure that's the right way to formulate it, just because almost everyone investing has made a king's ransom over the past few years, while the American worker has really struggled to see her income grow. So I tend to see all investors as really benefiting from the market's rally. And the folks I worry about are the people who are working their tails off and just earning a regular wage.
So if folks have made a king's ransom, are we in a bubble that's about to pop or popping, especially when it comes to tech?
Well, it's anyone's guess, but I know of deals where a firm is closing a private round, and the day they close, investors are offering to double the price. Lawyers working on SPACs did as many deals in February as they did all last year. So I don't think anyone believes that this can continue forever. And that's why when your stock goes up to 100 or goes down to 20, you just can't be too troubled by it, because maybe you weren't worth 100 and maybe you weren't worth 20. Maybe you're worth something in between.
Are SPACs going to end badly? That's what Charlie Munger just said today. It's another bubble that'll end badly.
I don't think you can paint with such a broad brush. There are good companies that are going public via SPAC, and then there are other companies that are using that vehicle because they couldn't get out any other way. I do worry that if you are availing yourself of a SPAC so you can market future results in a way that a traditional IPO wouldn't allow, that it encourages bubbly behavior. So many of the companies going public right now through a SPAC, I think, would have a hard time through a traditional listing, through a direct listing. Certainly when you're trying to buy companies that a year ago you would have said have to get bought, now can credibly say, well, if you don't pay up, we'll go public through a SPAC. So I do think that it's created more liquidity in the market. It's added to the bubbliness, but you can't say that every SPAC is garbage. Some are really good.
All right. Glenn Kelman, CEO of Redfin, always appreciate your metaphorical dialogue, and we'll do our best not to fall into the trap of looking for heroes and villains. Thank you so much for joining us today. That does it for this edition of Bloomberg Technology. Reminder, I'll be speaking to Airbnb CEO Brian Chesky on the back of their earnings coming up in the next hour. And about an hour after that, I'll be speaking with Salesforce CEO Mark Benioff. You do not want to miss either conversation. Stay tuned to Bloomberg Television. This is Bloomberg.